Hey, welcome investors to the 40 Finance channel. My name's Jeff Beers. Got a fun little exercise today, or an alarming exercise, depending on how you want to look at it. We're going to take my stocks today at their current prices and project where they would land in a market correction. So there's a lot of sentiment out there that the stock market is running high. There's a lot of historical data to support that as well. It really doesn't matter if you're talking about growth stocks or even stocks with a longer history of EPS. PEs by themselves, price to sales ratios, all those things are much higher than we've typically seen, particularly in stocks where we have a longer track record that we can actually go back and sort of measure what were investors paying for these stocks even just 2 years ago from a valuation multiple. So we're going to pick on the stocks that I own, and we're going to see what would happen if the market crashed, not necessarily in negative territory, but what if it crashed from a valuation perspective, right? What if valuations went back to kind of the mean that we've seen 2019 and prior? What would happen to those stock prices? Reminder, as always, in my stock picks and projections are just my opinion for your entertainment. Please make sure you do your own research before jumping into any stock. And of course, if you like this content and you want to help me out, please hit the like button, subscribe to the channel if you like stock market analysis. Thank you to everyone for your support so far. All right, we're going to use PayPal as the first example, and I'm going to show you how I get to these numbers. This is a pretty simple assumption-based exercise that you can do for any one of your stocks. It gets a little bit harder for stocks that do not have earnings or profits and a historical track record that we can go by. But I've got an example with DraftKings where I'll show you one way that you can do this for those situations. For PayPal, though, it's pretty easy. I'm just going to Yahoo here and looking at their statistics column. And if you're just a free Yahoo user, you'll have this quarterly look back that you can do. I'm using the annual because I pay the extra for the enhanced statistics or whatever. And for the annual, I'm targeting 2018. Okay, I want to get way before the pandemic or anything like it. 2018 in December was also a very interesting time because the market hit a low point on China tensions with Trump. So it gives us a pretty hardcore bottom, I guess, if you will, in recent years. Now, if you don't have the annual statistics, you can actually just go to quarterly and find the December 2018, which looks like it's right here. The numbers are essentially still the same, but you can pick whatever timeline you want to go back. You know, maybe for you, you want to go all the way back to 2017 or something like that. For me, though, I'm pretty comfortable with 2018, and I think that the market was trading at reasonable values at that time. All right, so back in 2018, PayPal had a forward PE of 29. We'll make that easy and just round it up to 30. Next, we want to go find the projected EPS for PayPal, so we go to the Analysis tab. And PayPal runs a traditional fiscal calendar, you know, the January to December, so this is kind of easy. The estimate right now is 456. And knowing PayPal like I do, we're pretty early in 2021, so I'm going to round this number up to 460. I actually think PayPal will come in even a little bit further above that. But let's just say our forward PE of 30 and our forward EPS at the end of the 2021 fiscal year will be 460. So when you multiply the forward earnings of 460 times the forward PE of 30, you get $138. So $138 compared to today's price of $298.37. That is a negative difference of $170. So if we saw a time when the valuation multiple for PayPal from a price to earnings perspective landed back at the mean of around 30, and we know that PayPal is projected to come in at about $4.60 earnings per share, that price would revert to $138, which is a downside of $170 from today. All right, so before we look at the other names, you might be thinking to yourself, am I projecting that PayPal's price will crash to $138? And the answer to that, where I sit right now, is no. I think that 2021 kind of continues on this overvaluation period. However, I do think here in February, we are starting to really push the valuation multiples across, hundreds and hundreds of stocks. The main key for this exercise is to just go back and see, what is a sort of fair price for PayPal and the other stocks that I own, based on how much money I have into them and what my cost basis is. And the main benefit to doing an exercise like this is it just gives you a compass of where you might buy additional shares if the stock were to drop X amount. So for example, if in PayPal my cost basis, let's say, was $99, and I know through this exercise that we could see a dip as far as $138 to get back to reasonable territory. In that scenario, I could technically add some shares here or there. Obviously, I probably don't want to buy at the $300 level, but who knows? You may want to pick some spots at $175 or $200 or something like that, knowing that $138 is kind of sort of your reasonable floor. All right, so now you know how I got to these valuations. Let's take a look at where my top 6 or 7 stocks would land if this formula applied at any time in the near future. All right, this is just a simple Google Doc that I added the data to save us some time here. All right, next up we have DraftKings. In this one, I used a price to sales ratio. And to not bore you to death, a lot of growth companies are in that 50x price to sales ratio right now. If you kind of go back to 2017, 2018, and just pick around a few growth stocks back in those days, you're riding closer to a 15-20 price to sales ratio. A lot of the more popular names, in fact, were down in that 3 to 4x price to sales. So 15 is probably generous, but that's what I'm going with. Then we use a sales estimate of $750 million in 2022. This would be the end of 2022, so it actually wouldn't get reported until 2023. And in that scenario, the share price would end up at $28. I'm at a $35 cost basis. So while I only lose $7 in this formula, keep in mind that the formula is out towards the reporting of revenue all the way in the first part of 2023. All right, next up is Etsy. I have a forward PE of 65. This was a little bit of a opinion call on my part. You factor in Etsy's growth plus the fact that it's an internet stock, so there's always going to be a lot of interest. So I gave them benefit of the doubt at 65. And then their projected earnings, and need to add a period here. Their projected earnings of $2.20 for next year. I added a couple cents to the analyst opinion, which I think was in the 216 range. Don't forget that Etsy's not going to have a huge growth year because they certainly benefited from people being locked up, and we don't necessarily know how that will play out in 2021 at the back half of the year. But assuming it was 220 when they report in January of 22, times a 65 forward PE, that would give us a price of 143. My cost basis of 133 would still be up about $10. All right, next up, TJX. 19 forward PE times approximately $2.66. Their fiscal calendar would not report this number until February or March of 2022, and that would leave a share price of $50. My cost basis is 48, so a net gain of $2 per share there. All right, Enphase, which of course is a new addition for me, and I've acknowledged several times how I overpaid for this one, but I'm okay with it because it's a much longer term acquisition for me. I did a 30 forward PE for Enphase based on their historical metrics. They are a profitable company. I wouldn't be surprised if this multiple was more like 40 or 50 in a regular market, but just to play the game fair, I put it in at a 30 forward PE times their projected EPS of $2.80 in January of 22. That is a share price of 84, more than $100 down from my $195 cost basis. So Enphase has the potential to be a big loser for me if we do revert back to the valuation mean. All right, next up we have Taiwan Semiconductor. You know, the chip manufacturing space never has very high multiples. So 18 forward PE for this one. Projected earnings of $4.10 for the 2021 calendar year. That would report on January of 22, gives you a price of $73 a share. I'm in at $85 a share, so minus $12 net for me if that situation were to occur. So looking at the full list on this valuation, you've got a loss, a loss, a loss, slight gain, big loss, and loss. All right, so despite how strong my cost basis looked today in today's valuations, if things reverted back to normal, so to speak, that you saw in 2018 or so, I'm looking at a pretty hefty cut on the valuation of my stocks. So what does this all mean to me? Well, there's a couple things, right? For starters, it means that I do need to be careful when adding positions going forward for a lot of my existing portfolio. But this can change in an instant if we get a market correction or crash. But as dire as some of that looks, we know that almost for sure we're going to get a market correction or crash in 2021. Crash is a relatively strong word, but I do see correction, pullback, anything like that to realign prices across PE ratios and earnings makes a ton of sense from here. Personally, I came into this same conundrum last summer where I was just really surprised at how high prices were moving relative to their expected earnings per share. But in late summer and through fall, and again here in January, I bought in on the premise like, hey, people are just buying. They're just buying, buying, buying. I'm going to pick my spots. I don't want to miss the entire rally. But we are coming to a point here where I think my number one goal is probably going to be to build up my savings so that I can take part in the next correction. Just to be honest, I burned a lot of savings here in January so that I could get into some of the technically hot stocks that I normally wouldn't touch at their current valuations, most notably Enphase, Unity Software, and even Square, which I hadn't bought into until January. All three of those stocks have insane valuation multiples that could definitely play out in their favor across 5 years. But for the next couple years, it's really hard for me to imagine that the stock prices on those three go much higher. And even if they do tap a higher point, I think eventually stuff settles down. 2021 probably isn't that year when we revert back to historical PEs, but I see a slow but steady pace towards that world across 2022 and into 23. So the best thing that we can all do right now, in my opinion, is just take a very close look at your portfolio. You know, run through an exercise like this where instead of like rooting for the stock to go up for no particular reason, just sit back and really crunch the numbers and say, you know, what is a fair price for these stocks that I own? We saw some prices come down at late October heading into the election. I think kind of like the fear of uncertainty was weighing at the market. But there's a certain point, I think, when we all have to say, gosh, that ran up a lot. Should I either cash out if I don't believe in the company across the long term, or should I know that I'm hanging on long and this one's going to be a little bit of a roller coaster ride? All right, guys, that's a look at where my stocks would land in a crash by using historical metrics anyway. Let me know what you think, which way you think the market's heading in 2021. Here we are at all-time highs. Does it keep going? Love to see what you think in the comments. As always, thanks for watching. We'll see you on the next video.